Welcome to the Opening Bell Report.
If you're joining us, you are likely looking for some clarity right now amidst just, well, a massive amount of market noise.
Yeah, there's a lot of panic out there right now.
Truly. So today's mission, we are unpacking a fiercely contrarian analysis report regarding a huge headline-grabbing event that just played out yesterday.
Right, the CoreWeave crash.
Exactly. CoreWeave stock, trading under the ticker CRWV, just violently crashed. 18.51%.
It isn't brutal to watch.
Shedding billions of dollars in market cap in a single trading session, closing at 79.56. And seeing a drop like that, especially in tech sector, it's the kind of thing that makes you question the underlying stability of the entire AI narrative.
It absolutely tests your conviction. I mean, when you look at the sheer volume of selling that swept through Wall Street yesterday, it just paints a picture of pure panic.
Yeah.
But our primary goal today is to step back from that emotional reaction on the trading floor.
Right. Take a breath.
Exactly. We are going to examine a profound disconnect between Wall Street's short-term algorithmic trading reflexes and the actual physical mechanics of building the infrastructure for our AI future.
Okay, let's unpack this because the tension here is incredible.
It really is.
On one hand, the broader market is just screaming panic, right? Hitting the sell button as fast as humanly or, well, algorithmically possible.
Mostly algorithmically.
Right. But the analysis report we're examining argues that this isn't a fundamental breakdown of CoreWeave's business model. It frames this as a mechanical repricing, and more importantly, a massive opportunity for anyone whose investment time horizon is longer than a single financial quarter.
Which is key here.
So let's start with the numbers that triggered the panic in the first place, because the bear case is built on some undeniably heavy figures.
Very heavy.
We are looking at an earnings per share miss of negative 89 cents. We have a net loss of $452 million. And perhaps the most shocking figure to the market, management issued a massive $30 billion to $35 billion CapEx, or capital expenditure, guidance for the year 2026.
And that CapEx number, that is the primary culprit behind the sell-off.
$30 billion is a lot to digest.
It's massive. But when trading algorithms, which, remember, they process financial releases in milliseconds, when they scan an earnings report, they are operating on very rigid, predefined parameters.
Okay.
The analysis report points out a critical flaw in how those algorithms are evaluating CoreWeave right now. The market is treating CoreWeave as if it were a mature, highly profitable, established software-as-a-service company.
Like a legacy tech giant.
Exactly. But it isn't. It is a hyper-growth infrastructure builder.
Yeah.
So when an algorithm designed to reward immediate cash flow and lean operations sees a $30 billion CapEx bill, its immediate logic is that the company's costs are spiraling out of control.
It just hit sell.
It hits sell, completely blind to what that money is actually being used to build.
So the algorithms see an expense, not an investment.
Precisely.
But let's ground that $30 billion figure for a second. What does that actually buy? Because if you are sitting there looking at your portfolio, taking an 18% haircut, you want to know where that money is going. We aren't just talking about buying a few extra servers and updating some software, are we?
Oh, not at all. That 30 to 35 billion is going into the physical reality of the AI revolution.
The actual hardware.
Hardware, real estate, everything. We're talking about acquiring acres of land for new data centers. We're talking about securing gigawatts of power from local grids.
Which you can't just do overnight.
Right, that is incredibly difficult and takes years to negotiate. It covers the installation of massive liquid cooling systems, too, because the newest generation of AI chips run insanely hot and will literally melt traditional air-cooled setups.
Wow.
And of course, a huge chunk of that goes to purchasing the GPUs themselves from NVIDIA at tens of thousands of dollars a piece. Wall Street wants immediate profitability, but the AI revolution demands massive, physical, upfront investment.
You have to pour the concrete before you can run the code.
I hear that, but we can't ignore the debt side of the equation. Pouring concrete is expensive.
Very.
The report highlights that CoreWeave has roughly $21 billion in total debt, and they posted a negative $8.06 billion in levered free cash flow for the trailing 12 months.
Right.
Just to clarify the terminology for those of you who aren't CPAs, what exactly does that levered part mean in this context, and why is that negative $8 billion so alarming to traders?
It's a great question. Levered free cash flow simply means the amount of cash a company has left over after it has met all of its financial obligations, including the interest payments on its debt.
Okay, so after the bills are paid. Exactly. It is the true measure of what's left in the bank for the business to actually use. So a negative $8.06 billion levered free cash flow means that after paying for their operations and servicing their massive debt, they are burning through $8 billion a year.
Which sounds terrifying.
It is a terrifying number for traditional value investors.
And the interest expenses alone are just wild. The figures show they absorbed $388 million in interest expenses in Q4 alone.
Yeah.
That feels incredibly heavy. I mean, spending nearly $400 million in 3 months just on interest. How did the analysis report counter that? Because on a traditional balance sheet, that looks borderline toxic.
It does look toxic if you view it through a traditional lens, but the contrarian argument here is that the debt is a feature, not a bug.
A feature?
Yes. The report outlines what they call a land grab strategy. Think about it like the expansion of the Transcontinental Railroad or buying up all the prime real estate in Manhattan in the 1800s.
Okay, I like that analogy.
If you borrowed millions to buy the Manhattan grid back then, your levered free cash flow would look disastrous for a decade. The interest payments would be crushing. But if you hold the territory, eventually the city grows around you, and you own the underlying foundation of the entire economy.
You control the grid.
Exactly. CoreWeave is intentionally absorbing these massive interest expenses today because you cannot build the world's most advanced GPU data centers out of thin air. They're laying the tracks right now to dominate the AI transport routes of tomorrow.
So they're just eating the cost of the land grab?
Yes.
But for a land grab to work, you actually need people to start moving into the territory and paying rent. And this is where the market seemed to selectively ignore some genuinely incredible numbers yesterday.
They completely missed it.
Right. While everyone was fixated on the bottom line miss and the debt burden, they completely glossed over the top line revenue growth. In Q4, CoreWeave posted $1.57 billion in revenue. That is a 110% year-over-year increase.
And the full year picture is even more aggressive.
Right. The full year 2025 revenue hit $5.13 billion, which is up 168% year over year. When you look at a multi-billion-dollar revenue base growing by 168% in 12 months, it completely reframes the narrative.
It's impressive.
Scaling from 0 to 100 million is one thing, but adding billions of dollars in new revenue in a single year, you rarely see that kind of speed, even in the tech sector.
You certainly don't see it with the legacy cloud providers. To your point about the rent being paid on this real estate, the revenue growth proves that the demand is real and accelerating.
The tenants are moving in.
Exactly. The market punished the cost of that growth, but completely ignored the materialized growth itself. But to fully understand why this contrarian view is so bullish on the stock despite the crash, we have to look at how that future revenue is structurally secured.
Here's where it gets really interesting. Out of all the complex metrics in this massive earnings release, the analysis report points to one single figure as the absolute most critical piece of the puzzle.
The backlog.
Yes. It's the metric that makes the entire bull case work. CoreWeave possesses a legally binding contracted revenue backlog of $66.8 billion.
We really need to slow down and unpack the math on this because this backlog fundamentally de-risks the entire valuation of the company.
Let's do it.
Let's look at CoreWeave's current enterprise value. Enterprise value is essentially the total price tag of a company. It's their current market cap plus that massive $21 billion debt pile we just discussed.
Great.
Right now, at this crashed stock price, CoreWeave's enterprise value sits at roughly $57.7 billion. Now, compare that to the backlog. Their guaranteed, legally binding future revenue of $66.8 billion actually exceeds their entire current enterprise value.
That is wild. The future revenue they have already locked in with signed contracts is worth more than the entire company is currently valued at, debt included.
Exactly.
So why on earth are the algorithms ignoring a $66.8 billion guarantee?
It comes down to standard accounting rules, specifically GAAP account. Under these rules, you cannot put that $66.8 billion on your income statement today because the compute services haven't been delivered yet. The contracts are signed, the revenue is guaranteed over the next few years, but it doesn't show up in the current quarter's earnings.
Oh, I see.
So an algorithmic trading model scanning for current profitability sees the cash burn, sees the debt, but is structurally blind to the vault of signed contracts sitting in the CFO's desk.
Wow.
The algorithm assumes the company is bleeding money into a void.
Which perfectly explains the disconnect. And if we pull that thread, it completely changes the context of that terrifying $30 billion to $35 billion CapEx guidance for 2026.
Completely changes it.
They aren't just taking on debt to build Field of Dreams data centers, hoping that if they build it, the AI companies will come.
Exactly. The customers are already there. The contracts are signed. The ink is dry. That $30 billion CapEx is not a speculative gamble on future AI demand. It is simply the physical cost of fulfilling orders that are already legally on the books.
They have to spend it to make the $66 billion.
Right. They know exactly who is renting the servers, for how long, and at what price. It changes the narrative entirely from reckless spending to guaranteed fulfillment.
That is a massive distinction. So let's pivot and talk about what this means for the stock's valuation today. Because the analysis report makes a very strong case that down here at 79.56, the stock is screamingly cheap.
It really is.
Since CoreWeave doesn't have positive current earnings, looking at a traditional trailing price to earnings or PE ratio is useless. Instead, the focus is on the price to sales or PS ratio.
Right. At the current beaten-down price, CoreWeave is trading at about 8.2 times its trailing sales. But again, valuing a hypergrowth company looking backward is a mistake. We need to look forward.
Okay.
Management provided revenue guidance for 2026, estimating they will bring in between $12 billion and $13 billion, and the report considers that estimate to be quite conservative given the backlog.
So if we do the math on that forward guidance, even if we assume they only hit the absolute bottom end of that range at $12 billion, the forward price to sales multiple drops to an incredibly cheap 3.4x.
Yep.
For a tech company growing this fast, a 3.4x multiple seems almost absurdly low.
To give that 3.4x multiple some real-world context, the analysis report compares CoreWeave to the gold standard of cloud computing, which is Microsoft Azure.
Okay, the big player.
Right now, Microsoft trades at roughly 13 times trailing sales. Now, Microsoft is a phenomenal, highly profitable business, but Microsoft Azure is currently growing its revenues at a rate of roughly 15 to 18%.
Right.
CoreWeave, on the other hand, is offering triple-digit growth, well over 110%, at what will be a single-digit forward multiple next year.
So as an investor, you are essentially buying triple-digit growth for a fraction of the multiple you would pay for a legacy provider's double-digit growth.
Exactly.
But that brings up an obvious operational question. CoreWeave is effectively playing the role of David fighting three massive, deeply entrenched Goliaths: Amazon Web Services, Microsoft Azure, and Google Cloud Platform.
The hyperscalers.
Right. AWS and Azure have practically infinite resources.
Yeah.
How is a relatively new player like CoreWeave actually beating them to these massive contracts?
It comes down to what the industry calls a pure play advantage. CoreWeave is a pure play AI hyperscaler. Hyperscaler just means they operate massive data centers that can scale computing resources infinitely on demand. But the key is the pure play aspect. CoreWeave was purpose-built from the ground up entirely for AI and GPU computing. They don't have the legacy baggage that Amazon and Microsoft have.
What kind of baggage are we talking about?
Think about AWS and Azure. They have millions of enterprise customers running boring traditional software on older CPU-based architecture.
Like basic web hosting and email servers.
Exactly. They have to keep those massive legacy server farms running, patched, and cooled. They have to balance their capital expenditures between maintaining the old world and trying to pivot to the new AI world. CoreWeave doesn't have to balance anything. They started with GPUs. Their entire architecture, networking, and power grid are optimized solely for artificial intelligence workloads. They are entirely agile.
Agility is a huge edge, but there is another massive structural advantage pointed out in the report. Because they are this specialized, agile, pure-play AI hyperscaler, CoreWeave has positioned themselves as NVIDIA's preferred deployment partner.
And the hardware advantage that creates cannot be overstated. Being NVIDIA's preferred partner means CoreWeave secures early, massive allocations of the absolute newest, most highly coveted chips on the planet.
The Blackwell Ultras.
Specifically the new Blackwell Ultra chips. Everyone in the tech world is fighting tooth and nail for these chips. But because CoreWeave's data centers are already perfectly optimized to run them, NVIDIA gives them priority.
Go, they get them first.
They are getting their hands on the raw compute power faster than the highly bureaucratic legacy cloud providers. AWS and Azure simply cannot easily replicate that intimate relationship or that deployment speed.
So if we synthesize all of this, we have the scary headline numbers and the massive debt burden. But underneath that, we have incredible 158% top-line growth, a legally binding $66.8 billion backlog that exceeds the entire enterprise value of the company, a deeply discounted forward valuation, and a structural hardware advantage with the most important chip maker on Earth.
That's a bull case in a nutshell.
That brings us to the final verdict. And to be clear, the analysis report is very honest about the harsh technical reality of the stock right now. The chart is ugly.
It is undeniably ugly from a technical trading perspective.
The stock broke aggressively below both its 50-day and 200-day moving averages during this crash. And for those who don't watch charts all day, those moving averages aren't just invisible lines, they are tripwires.
Exactly.
When a stock falls below, the massive passive funds and quantitative trading models are automatically triggered to sell to manage their downside risk. It exacerbates the sell-off, regardless of the company's fundamentals.
Mechanical.
The analysis even warns that because of this mechanical selling, we could see the stock test the mid-60s before it truly exhausts the sellers and finds a solid bottom.
Which means there could absolutely be more pain ahead for short-term holders. Calling a bottom in a falling knife situation is incredibly difficult.
So what does this all mean? If you are looking at this landscape, weighing the fundamental data against the technical chart breakdown, how do you synthesize the big picture takeaway?
The overarching theme is that CoreWeave is undergoing a very painful, very public transition. They are evolving from a hype-driven momentum IPO narrative into the reality of becoming a massive cash flow juggernaut.
Growing pains.
Severe growing pains. They are aggressively taking on necessary heavy debt today to service an absolutely massive $66.8 billion backlog tomorrow. The ultimate stance of the analysis report is that if you can stomach the near-term volatility, and if you can look past the short-sighted Wall Street algorithms that only care about the next 3 months, this crash is one of the most compelling risk-reward setups currently available in the AI infrastructure sector.
It's a classic case of the market panicking over the cost of the seeds while completely ignoring the value of the forest that has already been legally contracted to be harvested.
That's a great way to put it.
It really requires a high tolerance for seeing your portfolio swing wildly. But understanding the physical mechanics of the AI build-out presents a very strong, logical counter-narrative to yesterday's blind panic.
It does. It reframes the entire conversation. And as we wrap up our analysis of this situation, this raises an important question. A provocative thought for you to ponder as you watch this AI arms race continue to unfold over the next few years.
Let's hear it.
If pure-play hyperscalers like CoreWeave are aggressively locking up all the newest, most powerful generation of NVIDIA chips, like the Blackwell Ultra, just to fulfill the demands of their massive, legally bound mega customers, what happens to the innovative startups and the smaller enterprises?
Wow, yeah.
If they suddenly find themselves entirely priced out of the market or permanently stuck on a wait list for the compute power they desperately need to train their own models, how will they survive the AI revolution?
That is a fascinating dynamic to watch. Will AI consolidate power into the hands of the few who bought the land early? Or will the compute eventually trickle down? We will have to keep tracking it. Thank you for joining us on this deep dive, and we'll catch you on the next one.
Don't forget to like, share, and subscribe for more.